Hello, everyone, and thank you so much for joining me in this presentation covering inflation and interest rates for May 2026. Australia's inflation picture has changed noticeably in recent months. The latest ABS Consumer Price Index for March 2026 showed that headline annual inflation had risen to 4.6%. This represents a sharp increase, driven primarily by three specific categories. Firstly, transport costs jumped up by 8.9%. Housing prices then came in at second place as these rose by 6.5%. And then in third place, there was food and non-alcoholic beverages, which increased by 3.1%. As you can see from this chart, after a period of relative moderation through late 2025, inflation has clearly turned higher again in early 2026. Looking beyond the headline inflation number, the Reserve Bank of Australia pays very close attention to trimmed mean inflation, which is the RBA's preferred measure of underlying core inflation. As this chart shows, core inflation has been stuck at 3.3% for the past 3 months of January, February, and March. This confirms to us that inflation is not just a temporary spike, but that inflation has become embedded in the Australian economy, and if this inflation persists, it will cause the RBA to take even stronger action. One of the biggest reasons for the recent jump in inflation is actually geopolitical. The 2026 Iran war has significantly disrupted global oil markets and international supply chains. In particular, the closure of the Strait of Hormuz and damage to oil production infrastructure have pushed prices for fuel and petrol sharply higher. This is flowing straight through onto transport costs, which jumped 8.9% in the latest inflation reading. Higher fuel prices don't just affect petrol, they actually increase the cost of moving goods around the entire country. This cost eventually shows up in the price of almost every single product that we buy online, at the supermarket, or at the shopping centre. So, what does the Reserve Bank of Australia do when inflation rises this quickly? The primary tool the RBA has is to increase interest rates to slow down demand and bring prices under control. Higher inflation leads to higher interest rates because the RBA's main objective is to return inflation to the target range of 2 to 3%. By raising rates, the RBA makes borrowing more expensive, and this helps cool down the economy so that demand no longer outstrips supply. This brings us to the latest interest rate decision from the Reserve Bank of Australia. On the 5th of May 2026, the RBA raised the cash rate by another 25 basis points to 4.35%. This was the third interest rate increase in this current tightening cycle of 2026. The RBA made this decision with an 8 to 1 majority, showing strong consensus within the RBA board that action was needed. After a long period of very low interest rates, we are now firmly once again in a rising interest rate environment. From an interest rates perspective, what makes this situation particularly challenging is that Australia is facing dual inflation pressures. On the one hand, we have domestic pressures, given the fact that last year and early into 2026, the Australian economy was already running red hot. Demand for goods and services was outstripping supply, which is something that economists call capacity pressures. When demand is much stronger than supply, prices tend to increase more easily. On the other hand, we have the geopolitical shock from the Middle East, which has added a new layer of cost pressure, especially through energy and transport. Together, these two forces have made the current inflation challenge much more difficult to manage. Due to this combination, the RBA now forecasts that underlying inflation will peak higher than they previously expected. Inflation risks are now clearly tilted to the upside, with more volatility and more conflict in the Middle East will lead to a greater probability that inflation stays high for longer. While there are some downside risks to economic growth if the conflict drags on, the RBA's primary concern right now is preventing inflation expectations from getting out of control. Let's now talk about what this interest rate increase means for everyday Australian families. With the cash rate now at 4.35%, many households with variable interest rate mortgages are feeling the impact. Since the current interest rate tightening cycle began, many borrowers have seen their monthly repayments rise by $300 to $500, and in some cases, even more than that. This is putting real pressure on household budgets and sadly is obligating many families to cut back on discretionary spending, which are things like dining out, attending events or entertainment, and taking family holidays. Fixed interest rate borrowers who took out loans in the last 2 years are also likely to start to feel the pain soon as their fixed interest rate periods expire and they roll onto much higher variable interest rates. In short, higher interest rates are making life more expensive for millions of Australians with mortgages, credit cards, business loans, and other types of debt. So, how is all of this affecting the housing market? Higher interest rates are clearly cooling demand for property, as many potential buyers are now stepping back because borrowing power has been reduced significantly. We are already seeing signs of slower auction clearance rates and longer days on the sales market in many Australian cities. However, despite relative reduced demand from Australians, strong population growth driven by immigration combined with limited housing supply continue to maintain high property prices, especially in Sydney and Melbourne. Rental markets also remain very tight, with low vacancy rates pushing rents in most capital cities. This now brings us to the most important question. What should you do with this information? Here are some practical steps you can take right now. First, review your current mortgage. Speak to a finance broker like Forward Prosperity to check if you can refinance to a better interest rate or a more suitable loan structure. Second, consider your mix of fixed and variable interest rates. In an uncertain environment, having part of your loan fixed can provide you repayment certainty for a number of years. Third, build or strengthen your emergency savings buffer. With higher interest rates and cost of living pressures, having 3 to 6 months of expenses saved, either in an interest earning savings account or even your own mortgage offset, is more important than ever. Fourth, review your budget carefully. Look for areas of your budget where you can reduce spending to absorb higher mortgage and other debt costs. And finally, if you are an investor, reassess your property portfolio as cash flow management is even more critical in this higher interest rate environment. The key message here is don't wait. Taking action now can save you thousands of dollars and greatly reduce your stress in the coming months ahead. So, what happens next? The next inflation print will be released tomorrow on the 27th of May 2026. Then, the following RBA interest rate decision is scheduled for the 16th of June 2026. Markets in the RBA will be watching inflation numbers very closely. If inflation remains persistent, we could see further interest rate hikes. However, If inflation starts to moderate, the RBA may actually hold rates steady while it waits for future market expectations and inflation data. At Forward Prosperity, we help our clients navigate exactly these kinds of environments. Whether you're a borrower concerned about rising interest rates, a property investor considering modifying your portfolio, or a business owner interested in seeking commercial finance, we can help. Higher interest rates and persistent inflation make working with a finance broker like Forward Prosperity more important than ever. If you'd like a personalised assessment of how these changes affect your personal or business financial position, we'd be happy to organise a free, no obligation discussion with you. Visit forwardprosperity.com to book in a complimentary finance consultation. Thank you very much for watching this presentation on inflation and interest rates for the month of May 2026.